Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, everybody. Today we have one of our favorite guests back on the show, and this time he brought a friend. We got Owen Lamont, portfolio manager at Acadian Asset Management. He's been on the faculty at Harvard, Princeton, Yale, University of Chicago. He also writes the blog Owenomics. And he brought Randy Cohen. Randy's professor of finance unit at Harvard Business School. Has such a fascinating bio we'll get into, including some of my favorite papers over the years. I'm sure you guys have seen us send out a few of these, The Idea Farm. Owen and Randy, welcome to the show.
Great to be here.
Hey. Owen, we had a blast a couple years ago, and I told you this time, I said, you can bring somebody, bring a friend, could have brought anybody, and you said, this guy, Randy, he's a banger. I'm going to bring this dude. Tell why'd you pick Randy, and how long y'all known each other?
Well, I was Randy's professor at the University of Chicago. Randy is going to know better, but it was probably in the late 90s.
I was there 93 to 98.
And Randy is endless stories. So I know you don't have like 5 hours, but if you had a 5-hour block, Randy could fill them. And he has done many interesting things.
And Randy, so besides shooting spitballs in the back of class at your professor, give us, since you're new to the audience, give us a little background on what you've been up to since that time.
Got the PhD at Chicago in 98. Still really proud to have accomplished that. Incredible place, incredible experience. And then started teaching at Harvard Business School. And I taught investments here for many years. And then I went and taught that course across the river at MIT Sloan for about 5 years, which was also a wonderful experience. But as great as MIT was, I really, coming back to HBS, felt like coming home. And so about 10 years ago, I came back. And the big change there, when I came back, I have a degenerative eye condition, retinitis pigmentosa. And I'd gone from guy with incredibly bad eyesight when I went to MIT to blind guy who could see a little bit when I got back to HBS. And that meant I really couldn't teach the classic HBS case method anymore because I couldn't see which students had their hands up or anything. I needed to develop something new to teach. And I thought, well, one thing I can do is lots and lots of one-on-one meetings with students. So I created a course called Field X, which is basically an incubator for startup businesses being started at HBS and at other parts of Harvard and other local universities. And so we have about 70 teams each semester, 70 businesses each semester being launched out of the class. Not all of them launch, of course. Some of them are wonderful student projects that they decide, you know what, I'm going to take a fantastic job offer I have instead. But we certainly have dozens that end up being full-time businesses run by students, and now hundreds of them over the life of the class over the last decade. And so that's been super fun. And then I work on other kinds of projects in the investing world and stuff like that.
What a fun day job, going in and chatting about all these fun ideas. You got any memorable companies that have spawned out of that? That sounds like endless playground.
I ran into my mentor from HBS, who's now emeritus. And when I told him what I was doing, he looked at me and said, "They pay you to do that?" I was like, "Yeah, don't tell them I'd do it for you. This is so much fun." We had some big successes out of the class, which are fascinating. And there's a company called Viho, which the guy came to me and he said, "I'm going to be Uber for package delivery." And I said, "Didn't Uber just say they're going to be doing package delivery?" He said, "I'm going to do it better." I thought, okay, good. He's arrogant. And then I said, "What are you going to do first?" He said, "I've taken a temp job as a package delivery guy, and I'm going to deliver 1,000 packages before I do anything else." I said, "All right, good." He's humble. That's the combination you're looking for. A little arrogance, a little humility. Gosh, he went through so many things, almost got deported multiple times, almost went under multiple times. But then the pandemic hit and suddenly everybody needed everything delivered. And his company just shot to the moon, and he's doing amazing things. I'll mention one other really fun one that hasn't taken over the world yet, but I think has incredible potential. It's called Halo Braid, and Yinka is the name of the student. She is a hair influencer and scientist with multiple degrees from MIT. And she said, look, 8 billion hours a year are spent braiding human hair. And she said, we've had industrial rope braiding machines for 100 years. It's crazy that 8 billion that people are getting, repetitive stress disorders. When you go to get your hair put in rows, it takes 6 or 8 hours typically and costs a huge amount of money because you're paying a skilled professional to do that work for hours and hours. She said, she could develop a machine that the skilled professional could use so that it takes an hour or so instead of 6 hours, and the cost would be lower, but the stylist could still make just as much money and put more effort into their artistry and less into repetitive twisting. And she's developed the machine, and I'm trying to help her take that to the next level. In fact, she's going to be my guest in class next week.
Very cool. Well, it doesn't sound like I'll be a customer. I need a little more hair for that, but I love this idea. Why don't we stay on kind of this private world for a second? Randy, you've written and been involved in your career a fair amount of insight into the private equity world. Talk to us about private equity at a high level, why this is a focus, and a little bit about your work there and insight as well. And Owen, you can chime in as you see fit.
I'll just throw out a little love to hear Owen's thoughts as well. Big picture, obviously private companies make up a really big chunk of the economy. And you can't expect to talk to finance professors for more than a couple minutes without them mentioning that the one free lunch in investing is diversification. So you can certainly understand why people say, hey, if there's trillions of dollars worth of private companies, you wouldn't want to have all your money in public companies. You're missing out on a big diversification opportunity. And so that was one of the solid arguments made for the development of PE. And it's been very successful in terms of the performance. PE's average returns have been a couple, I'd say you can get different answers by doing the analysis different ways if you want to get a certain answer. But I think a fair reading of the data would be that PE has delivered 2 to 4% a year ahead of the public markets over the last few decades, which is a lot. Okay. That's terrific outperformance. And the reported volatility of private equity has been significantly lower than the public markets. Now, the concern, which has been a concern for a long time among people who think about this stuff hard, but has really come to the fore, like everybody started to notice, is that there is smoothing in these returns. Since nobody knows exactly what a private company is worth, take the COVID quarter, the first quarter of 2020, the S&P 500 was down 20%. If you think about a typical leverage buyout deal, the amount of leverage implicit in the deal suggests you would think it would have been down maybe 30, 40% more than the market. So that is to say 20 times 1.3 or 1.4 to reflect the leverage. So maybe down 25, 28%. But instead, PE reported that they were only down 10%. Now, PE came out looking great from that because the market shot back up later. And so PE's position was, we knew the market was panicking, and it's not our job to panic just because the market does. It's our job to report what things are really worth. But there's a flip side argument that said, look, they were just whistling past the graveyard. Yes, things turned around. That's great news. But they had the ability to tell their investors it wasn't down very much, which is very comforting. But that doesn't mean it's actually true. If they'd tried to sell all that stuff down at the bottom of the COVID fear, they would have gotten much, much lower prices. So there's a lot of controversy about that, but you could certainly understand the appeal of a sector that says we're going to give you above market returns with below market volatility. And so I think that is responsible for a lot of the growth.
You mentioned kind of the volatility smoothing, and we always poke fun at the managers who claim that, some of these are single digit vol, and you get some of these where it's like the private credit. They're like, yeah, this is like a 3 vol. And I'm like, why not just say 0 at this point? But to their credit, KKR posted they have some actually sneaky good macro, and they posted a chart that at least adjusted all of the private asset classes for what they consider to be vol smoothing. Now, they still assumed the returns were going to be way higher. So, you're a private shop. You're obviously going to say our expected returns are going to be way higher, but at least they adjusted the volatility. So kudos to them. I think that's become at this point pretty well known, as when it used to be kind of a wink and nod. And you hit on, to me, as I've gotten older, the most interesting part about private equity was simply the breadth. There's thousands of public securities, which sounds like a lot, but there's an order of magnitude more private companies. Now, some of them are obviously the local hair braid shop, or they always joke about the dry cleaners that everyone wants to roll up, but some of them are incredible businesses all the way up to SpaceX, trillion and a half company. But one of the things you kind of talk about is like, can we start to model and come up with private equity in public markets? So a liquid approach to private equity. Would love to hear your thoughts on that general topic.
This is something I've been working on for a long time. I gave a speech, it's now over 25 years ago in 2000. At HBS to a group of asset managers and asset owners saying, look, it's weird that PE is not bigger, right? Why is this like 3-4% of world capital markets given the impressive performance? And one answer could be, people don't believe the volatility claims. But really back then, people did believe them, right? 25 years, as you say now, it's funny. It went through a period where it was wink and nod and people would sort of, chuckle over it. And now, if I mention that issue, if I go into a meeting, asset owners will say it in the first 5 minutes of the meeting because they want me to understand they're not the sucker at the poker table. They know what's going on. So you're right. It's become very widespread. But what I argued is if you think about what private equity, and let's just focus on leverage buyout, which is sort of the heart of private equity. If you think about what they do, they're identifying companies that are highly profitable, because otherwise you're not going to be able to pay the interest on the deal. They're really smart about picking industries because they invest in every industry and they own those companies, so they know who's thriving and who's struggling and where to put the next 100 million. They invest in low multiple companies. Well, we know high profit, low multiple investments are exactly what quants like the best. So that seems really smart. And we know they're smart about picking industries. There's great research that says that these folks are excellent at picking industries. And then you're going to put a little bit of leverage on it. That ought to add something to returns. This seems pretty great, but this all seems like things that smart public investors can do. And some of them do, maybe not many do all of those things, right? What if we developed liquid private equity? We said, we're just going to copy every smart thing we can find that PE does. Oh, you tilt towards smaller companies, we'll tilt towards smaller companies. You tilt towards companies with low risk, great, we'll find low risk companies. And in fact, it's a funny thing because if you list the things that make you feasible for an LBO, you're going to need high profit, as I say, in order to pay the interest. You're going to need a low multiple because if you pay 30 times earnings, that's a 3.3% yield. That's not going to cover your interest costs. You're also going to need low risk. As I say, no one's going to lend you 2/3 or 3/4 of the value of a deal if it's super volatile, right? You're going to need it to be relatively small, and you're going to need a high payout ratio, right? Because if the company plows every dollar back into growth, well, then there's no money left to it. Well, guess what? High profit, high payout, low multiple, low risk, small size. Those are the 5 Fama French factors. So the exact 5 things that a quant will tell you leads to outperformance are the same things LBO focuses on. So now you say, what if we get the data on what PE holds and we copy their industry tilts that they're so smart about, and then we copy those factor loadings that are such a core part of their success, and then we copy adding a little bit of leverage. And again, it's not a huge amount of leverage because a typical public company is 30% debt, but these aren't typical public companies. These are the high debt capacity public companies. They're 40 or 50% debt. You only need 0.3 turns of leverage to get them up into the 60s where typical PE deals are. Well, gosh, you ought to be able to capture pretty much the performance of PE while being liquid and accessible, which is so powerful because there's so much, half the money in the world just can't invest in PE. And it turns out it's really useful for that half, but the other half that can invest in PE, they also find it really useful. And that is because they need some kind of liquidity buffer for their private equity investing. And that's anything from a pension fund to an endowment to, frankly, these new evergreen funds that are becoming so popular. You need some place to put the cash while you're waiting for the next capital call to come in. And so we think that liquid PE is just an incredibly powerful idea and really useful for lots of different kinds of investors.
Owen, what do you think? I think you accidentally put yourself on mute. Normally you're the talker here. Jump on in, buddy.
I didn't mean to go on and on, Owen.
No, it was great. I got some follow-ups.
Randy is singing this love song of, unmitigated love to the PE industry. And I just want to emphasize that there are some downsides. I mean, you guys are polite and you're talking about volatility smoothing. I mean, volatility smoothing is just lying or just making up numbers. And, Randy and I are both economists, and economists like prices. Prices are determined by supply and demand, except in the private equity where they're just made up numbers that are meaningless. So that might be an overstatement, but I would just want to caution that an asset that claims to have a price, but you can't trade at that price, that's not a price. That's something other than a price.
Here's the version of your argument that I think is the most indisputable. My friends who run mutual funds say, look, when COVID hit and my Delta Airlines stock was down, 70%, I also knew that the market was overreacting. I also thought it was a panic, but I had to take the mark down anyway. How come these private equity guys, how come if Blackstone owns an airline, they don't have to take the mark down? They can just say, oh, we think it's only down 10%. That seems unfair. In other words, where I think the PE folks have at least an argument to make is to say, look, sometimes it's possible the market does overreact, and having the ability to be, more honest about it has value. Now, I'm not saying that's a devastating argument. I think that the point you make is a great one, Owen, but just to say it's not completely crazy for them to say that. But I do think that the mismatch between where with anybody trading public securities, where of course you just have to reflect price, and then in the privates where it's the other end of the spectrum. That seems a little hard to explain. And of course, Owen and I both know Cliff Asness quite well. Cliff has a way with words and, dubbed this technique volatility laundering, which maybe that's in between volatility smoothing and lying in terms of its level of harshness.
What do you think the institutional world receptivity has been to this idea of public market private equity? And we talked about it a few times on the podcast. To me, it's incredibly attractive for all the reasons one would assume. You have liquidity, you have daily marks, you have tax efficiency, on and on. Has this started to be embraced by the institutional community at all? And how do you guys think about it here in 26?
I would say slowly, there's a lot of enthusiasm. I've done, I would say, over 200 meetings with institutional investors about this subject. And with only a handful of exceptions, there's been real enthusiasm about the idea. But then when you say, hey, would you like to write a $100 million check for it? There's a tendency for folks to say, could somebody else go first? And then, once this is well established and there's been a couple articles on Bloomberg about it, then I can write a check. So you have a little bit of that. We've worked with a Canadian bank that's been pretty aggressive in this space. So we've seen some stuff. There's definitely real interest out there, and people are starting to actually write checks. But there's also a little bit of, hey, this is a new idea. Can I see sort of more evidence that I'm not going to get fired for doing this? I think that's normal in institutional investing.
You kind of touched on it, and there's kind of two ways to do it that I think when it comes to the public side on the implementation is on the kind of the leverage target. And just one more time, do you think that explicitly saying we're going to buy companies that lever up their balance sheet or leverage the whole portfolio, or do you think it just doesn't matter? Because there are kind of two ways to think about that.
That's right. And you probably know Dan Rasmussen at Verdun, really smart guy. And he had a clever idea with this. He said, look, people hate to hear the things are leveraged. So the thing they hate the most is to have the leverage on their own books, right? And so that's one of the big pieces of appeal of PE is that you get the extra returns that come from leverage, but it's not on your own books. But what they like even better than having the leverage on somebody else's books is the more levels down the leverage can be, the further from them, the better, right? And so Dan's idea was, why not? What if you bought companies that are very highly levered, that are levered, they're public companies, but they're levered as much as LBO deals? Well, he did the research, and what he found is, a lot of those are really troubled companies, and those turn out not to necessarily be such great investments. So then he came up with a schema to say, let's figure out how we can buy companies that are very highly levered, but not troubled. And he built some strategies around that. The problem is you can't put too much money to work. You can't really help institutions a lot with that because there's just not enough dollars that you can put into that really pretty small subset of companies without moving prices too much. So it's a good approach. I respect it, but it's got limits. And if you want to really kind of change the world and offer something that's super useful to institutional investors and to retail investors and so forth, you need more capacity. And so to have more capacity, what you're going to need to do is to take those companies that are moderately levered by public market standards, but not as levered as an LBO, and then add a little bit of leverage to the books. And again, from the outside. And that's only about 0.3 turns of leverage. So it's not that much, but it makes a difference, right? You can see if the market premium is about 5%, and then if picking the right industries and the right kinds of companies, all those pharma French things, gets you another 2 or 3%, then you've got 8. So 0.3 times 8 is 2.5, 2.4% of extra performance that you're adding through the leverage. That's really quite meaningful. And so my view is it's worth doing. Look, you can do products without leverage. Nothing wrong with that. That's right for some markets. But I think there are people who will want to capture that couple extra percent to get the true PE-like performance. And I don't think it adds too much risk because you're not adding a ton of risk. And you can hedge the downside. So to replicate that smoothing effect that you get in private markets, right? You say, well, we'll buy some put spreads or something like that to protect against a crash. So then you've got a thing where you're adding a little bit of leverage, but not a scary amount of leverage.
One of the common themes that I think the more experience I have in the investing world, and there's a thread in here that we'll touch on a few times on the different topics, is obviously that humans are involved in these markets, but very structural.
Not for long.
Not for long. But
I'm kidding. Humans are great.
But there's career kind of reasons that push these assets, push some of these ideas in different directions. We just had a email thread this morning where there was a institution that decided not to approve some product, and my team was kind of frustrated. And I said, look, you got to remember, the gatekeepers on this particular idea, this means more work for them for no additional compensation. So you got to understand that like the roadblock is not the product. The roadblock is not, is this a great idea? The roadblock is some guy sitting at his desk is like, I don't want to do this. And so this applies to private equity. We'll talk about it with the best ideas later, but it just applies how humans are involved in markets in general. It was funny. Owen was on the podcast. I think it's almost, 2024.
I think it was October, 2024.
Yeah. And it was funny because we were joking about Korea, and one of the topics we talked about, you said, well, the US stock market is Koreafying. And then Korea said, hold my beer. Do you think that was interesting? I had a tweet at the beginning of March, because a lot of Americans don't pay that much attention to foreign markets. And I said, without looking, try and guess how much the South Korean stock market up is in the past year, past 12 months. I'm like, got a number? I was like, no chance you're anywhere close. And the answer was like 180%, like nearly a triple. Now, then it proceeded to go down, a bunch after that, but just an astonishing move. Any comments or thoughts about the bananas, kind of what's going on there, and then kind of how it trickles into what's going on here?
I think there's two phenomena. What's bananas is weird small cap stocks in the United States that are like meme stocks. I think that's a different phenomena than like the entire Korean stock market doubling or tripling, which could well be rational for all that I know. So I would say that the main thing I take away from the fact that the Korean market almost tripled is everybody should be globally diversified. It makes no sense to invest in only the United States. That's a crazy, innumerate thing to do. And, your baseline should just be to hold the world market portfolio. And if you had done that, you'd participate in the Korean stuff. I do feel like since we've talked in October 2024, Meb, the market has gotten crazier in terms of some of the fringe things. I'm not sure if the core of the stock market has gotten crazier, though. I don't know what Randy thinks.
I actually have a question for you about the driver, Owen, which again, maybe it's outside what you've been researching, but maybe So there's this phenomenon where if you have a relatively small market like Korea, compared to the global market, if you had sort of half the world that said, well, of course, we're not going to put any money into Korea, that's some weird faraway land. And then you have this incredible cultural thing that's occurred. I saw you've written articles referring to Squid Game, K-pop Demon Hunters was the biggest movie of the year, the K-pop phenomenon more generally in music, really extraordinary cultural dominance by Korea for such a small country. And I could imagine that sort of 20% of the money in the world said, well, we didn't have anything in Korea, but gosh, my kids are watching this Korea stuff all day. I think we have to put in a market weight there. But then if you do that, that could really move a market of that size a lot. If you sort of play around with elementary kind of Gordon growth model calculations or whatever, a little money flowing in from outside can really be impactful. So I wonder, is that part of the story there? Is that outside money came in, or is it just the enthusiasm of people in Korea for the future of their own country?
I don't know the empirical answer, but I can tell you that the net dollars, the Koreans have continued to buy more U.S. equities than they're selling. So it's certainly the Koreans, maybe they like Korea, but they're still net buying, sending more money from the U.S. equity market than they're sending out. I think that story that you told, that's kind of like a Merton investor recognition story. And it does explain things like whenever a stock is in the news, it goes up because people just notice the stock. I don't know evidence supporting that claim specifically for Korea, but it makes a lot of sense to me. I'm trying to think of another example. I think when the Berlin Wall fell, there was lots of money flowing into Germany. And so maybe that's a good example. But I have never felt the impulse to buy Korean stocks after watching Squid Game and Parasite, but maybe you have.
Well, my colleague Jonathan Wallen here, I know, has done some work looking at how much European money has flowed in to the U.S. market in the last 25 years versus a much smaller in the other direction, and that it could be somewhat impactful on the outperformance. The U.S. market, of course, cause and effect are always hard to untangle in these things. And very interestingly, certain countries invest, I can't remember, but it's something like in Germany, they really like Microsoft, but not Apple, or the other way around. So these flows things, I mean, I think you and I have a shared fascination with this notion that, like, in the end, if there's a lot of buying, it does move the price regardless of what logic would say. And sometimes that buying, usually rational forces prevail, but there can be moments.
It could be that your story is a good story for Japan because, like, Warren Buffett said, to buy Japan. That would be a theory. I don't know.
The flows comment is interesting because, as you mentioned, it works both ways. I have some friends that run ETF shops, and I often said, who's buying all these funds of yours? they're raising a ton of money. And for some of them, particularly the hot sauce type of funds, the ones that are really volatile and really esoteric, there's a lot of actual Korean money, which is interesting. But the flows topic is interesting because we chatted, Owen, last time about, is the market in a bubble? And we were talking about valuation and sentiment. And one of the things that hadn't really started to come online yet, at least not in a big way, was IPOs. And now, at least according to Kalshi and the prediction markets, you will probably see some of these companies start to go public, including some extremely large companies like SpaceX, which also creates some interesting problems for some of the index providers and funds that follow them, because all of a sudden you have $1.5 trillion company that is going to be added to all your indexes. How do you deal with that? And they're kind of scrambling to figure that out. Maybe just talk to us in general about public markets today, the IPOs, we're going to see them, and then how kind of some of these flow issues could impact markets.
Sure. Okay, so when ChatGPT came out, which was, I believe, November 2022, I was thinking, okay, obviously this is revolutionary technology. Obviously it's way more impactful than the internet. So what's going to happen is we're going to see 1999 all over again. There'll be a huge boom and a huge bubble. And I don't think, and that happened. We've seen a huge increase in CapEx and a lot of excitement about AI, but what we haven't seen is a wave of issuance like we saw in the 90s. And the issuance took place both in the form of IPOs and in the form of existing companies, like in 1999, it would have been Cisco, issuing equity. So we just haven't seen that. And it might be, as you say, Meb, that 2026 is going to be the year of that happens and the IPO wave arrives. Supposedly, SpaceX might come out in June of 2026, and maybe the other two, OpenAI and Anthropic, maybe late 2026. So if that happens, I think that would be an indicator that the bubble has arrived or the bubble has started, because every equity market bubble that I know of has had a huge wave of IPOs. And it is, and Randy can comment about this from the standpoint of the private markets replacing IPOs, but it is kind of amazing how few IPOs there have been. And I would even say that right now, today, March 2026, we are in a massive IPO drought that is comparable to the 1970s or the 1930s, if you look at the percent of the market that is a recent IPO. So to me, I know that the market doesn't look cheap based on valuation, but if you only knew the number of IPOs and how much they're worth, you would say like we're in the Great Depression or something, or we're in a horrendous bear market like the 1970s. So there are many theories offered for why there haven't been why there have been so few IPOs. And one of the theories is it's all going into private markets, into PE and stuff. And that's a perfectly fine theory. But we just had a huge wave of IPOs in 2020, 2021. And so we know that it's possible to have one. We just had one 5 years ago. So it's not like the regulations or whatever it is are preventing IPOs, but for some reason we just have a huge shortage of them. And maybe, Randy, you can tell me why.
I don't think I can. It's a great point, and I think you're right that it is not a debate-ending argument, but a debate-starting argument for anyone who says, oh, prices are obviously too high, as well, really, you've got to then believe that even the insiders are fooled, right? Because, these big companies, and by the way, every day you read in the papers about the huge investments they're making in data centers and related technologies. So they're putting lots of money out there. So it's not like they would, if they were issuing stock, it's not like they'd have to say, oh yeah, we're issuing because we think our stock's too high. They would have plenty of stories to tell about, well, of course we're issuing stock. We need money because we're going to build these world dominating AIs and data centers and all this stuff. So they've got a perfect story, and the prices seem high enough to justify it by Owen and I playing around with our valuation spreadsheets. And yet the people with decision-making authority are not saying, oh yeah, we're dying to sell stock in our hyperscaler company and take advantage of these poor fools out in the market who are overpaying us. So it does make you think. Now, it is possible that they're just as big suckers as the rest of us. So that's a story you could tell. But I think it's true that it's a lot easier to call bubble when you have these companies all out issuing, whether it's through new IPOs or through big issuance. And your point about 21 is a great point, that if this were due to Sarbanes-Oxley or other regulatory things that make it unappealing to go public, that stuff didn't really change a lot in the last few years, to my knowledge. I mean, I'm not an expert on regulation of public versus private companies, but I haven't heard a lot of people saying that's changed so much. So it's a really great question.
Owen had a nice piece a couple months ago that I'd not seen before. And one of the interesting takeaways I had in general, I think a lot of people assume that CEOs are megalomaniacs and really bad at capital allocation and timing. And some friends at O'Shaughnessy had put out, this is 5, 10, 15 years ago, a really beautiful chart that showed expensive companies and then all the way down to really cheap companies. And on average, the expensive ones issued shares and the really cheap ones were net buyback shares. And, Owen had a great chart where he showed the market level CAPE ratio versus issuance. And you would assume that some of these companies would be issuing shares at this point. And my only guess is some of these big dudes have so much damn cash flow. In the late 90s, a lot of these big companies, some of them started to debt fund, some of them just didn't have as much money to play with. I wonder how much of that plays into it, and then how much of it is just simply they got the cash, they can spend it, and the supply will eventually come from the IPOs. I don't have a good answer, but I loved, I don't know if it was in this piece or another one, where Owen was just like, well, there's no reason the valuation can't go to 60 or 80. And I was like, can you imagine the world? Like, people would lose their minds. Probably be a lot of fun, by the way, but.
Japan's CAPE was 60 in 1989 or 1990. That's how high it could go. And, we're all old enough to have lived through 1999 when NASDAQ was like amazingly too high, and then it doubled. So that's what a bubble is. A bubble is when you think everything's too high and then it doubles. So going back to this thing about they're too profitable. Back in 1999, Cisco was an incredibly profitable company, but it still issued equity. And I agree that they have less need to issue equity when they're profitable. But just like Randy said, they have every reason in the world. They have huge capital needs. They're spending billions of trillions of dollars on building these data centers. They need the money. The example I'd say to you is GameStop. Okay, so GameStop was a company that prior to June 2020, prior to the GameStop episode, January 2021, it was repurchasing equity. And then its price went up by 100-fold. And so it started issuing equity. And it's not that it suddenly had more cash flow or had less cash flow or people were going to the store more or less. It's just that the price went up. So just as you say, companies are contrarian and they time their own stock and they're good at it. And historically, they've been great at it, both in the time series and the cross section. And one last thing, I think you said, Randy, they're megalomaniacs or whatever. I think CEOs have always been very confident and very positive about their own stock. And they would never say, they rarely say my stock is overvalued. Just like they would rarely say my kid is stupid and lazy. They would always say my kid is great and my stock is undervalued. On a few small occasions, they have said my stock is overvalued. But I think CEOs were also very overconfident and positive in 1999, yet they issued equity then. So again, it's a puzzle.
By the way, a funny side note, Owen and I don't always agree on everything on public policy, but one thing that drives us both crazy is the sense that there are a lot of people out there who they decide who's on their team and then they, kind of criticize whoever they see is not on their team, regardless of what they do. And an example I think we've seen in recent years is when the big tech companies, and by the way, I'm sure I fall into this trap too myself, but I try not to, right? And Owen tries not to, and not everybody's even trying. Well, one thing you've seen a lot of is people who view big corporations as bad guys and big tech companies in particular. And when they were just piling up money and not doing anything with it, people were enraged. They're like, this money's just sitting idle in their coffers, which already as economists, financial economists, we're like rolling our eyes at, sitting idle, but whatever, it's sitting idle in their coffers and they should be doing, well then, so now in the last couple of years, they started to invest all that money, right, in real physical stuff that gives real jobs to real folks who get out there and work all day. And they're enraged at that too. They're like, oh, this is so terrible. They're building all these data centers and it's all. So, it's for some people, you just can't win.
It reminded me a little bit as we were talking about the valuations and just how wide they can swing and how this is nothing new. Professor Schiller had a paper where he's looking at sectors, but 100 years ago in the 1920s and 1930s. And we'll put a link in the show note, listeners. It was called Changing Times, Changing Values. And utilities, how boring. Well, they're kind of hot again now with all the AI going on, but utilities for many decades have been a boring, almost like a bond when people think about them. They hit a CAPE ratio of 60. That's like Japan territory. And then I think the low in 1932, railroads hit a CAPE ratio of 2 and change. So they can move a lot. And it's been true over time for as long as we've been around and before that too.
Well, it's funny when people ask me about AI, I say, look, obviously there's people who think AI is going to be just like moderately important. Let's say the internet important, but not. And I say my own view is there's a reasonable debate to be had whether AI is going to be the biggest innovation since electricity or the biggest innovation since fire. That's really the level we're talking about here. And so, yeah, obviously utilities were the AI of 100 years ago, right? And the idea that, oh my gosh, we can create a company that's going to give power that can be used for anything. You do anything with it, right? That's what electricity was. And that's what AI is. And so if people want to put big multiples on some of the companies, obviously what's so tricky is trying to figure out, well, who's really going to make a lot of money from AI, right? Because let's say you have sort of a normal company that does, kind of has a lot of white collar workers, and say, well, look, all these people are going to be way more efficient because, the email that took them an hour to write, now with AI, they write it in 5 minutes so they can do 12 times as many emails. And so then you think, well, that's amazing. Their workers are going to be way more efficient. They'll produce more for less. But of course, the competitors are also going to produce more for less. And there's going to be price competition. And how much more will that company be worth in the end? It's not at all obvious. And so then people say, well, what about NVIDIA, though? They're a sure thing because everybody's going to need those chips. But gosh, you ask yourself, NVIDIA designs chips. Like, couldn't somebody hire a bunch of really smart designers and catch up to that someday? Like, is it really the case that that's sort of a guaranteed monopoly-ish type scenario forever? So figuring out who deserves that 60 multiple, it's above my pay grade, I'm glad to say. I admire the people who can figure that out.
While we're talking about CAPE, this might be a good time to talk about interest rates because Shiller has this new concept, I don't know how new it is, the excess CAPE yield, where he's comparing the inverse of CAPE. So CAPE as a yield minus the real interest rate. And that's a pretty interesting, when we talk about whether Japan had a CAPE of 60 or, utilities 100 years ago, you have to remember that interest rates, especially real interest rates, were different back then. But Randy, why don't you tell us your shtick about what is weird about the market in the past 5 years?
Yeah, well, this is something that's been bothering me because in late 21, the long-term real interest rate in the U.S., the 30-year TIPS rate, was about minus 0.5%, okay?
The real one.
The real. This is the TIPS, the Treasury Inflation Protected Securities. Yeah. So this is a real rate, was minus 0.5. And last I looked, which was, a month or two ago, so it may have moved a bit, but was in the neighborhood of 2.5, right? So that's a 300 basis point move, a 3% move. Well, if you've ever built a valuation spreadsheet and you get an NPV of something and then you change the interest rate by 300 basis points, it is a mammoth effect. Obviously, people who are familiar with bond duration, which probably includes most of your listeners, know that the first order approximation is you take the duration of the asset and you multiply by the change in interest rates. Well, a typical estimate of the duration of the stock market, it's actually a classic sort of grad student finance problem, is 1 over the dividend yield. So if the dividend yield is 2%, that says the duration of the stock market is about 50. And there's other research that, usually gets results in that same kind of range using other methods, 30, 40, 80. So 50 times 3% is 150% move. Well, obviously, of course, the first order approximation breaks down at an interest rate move that large. But I can tell you that in 2021, the country of Austria issued a 100-year bond, coupon paying bond, that also had a duration around 50, so similar to the stock market. And so you might ask yourself, okay, well, if this big interest rate move and the rules of duration say that the value of that bond is supposed to fall 75%, did it really? Did that bond trade down 75%? And the answer is it sure did. So there's a really good argument that between late 21 and, late 22 or mid 23, whenever the interest rates peaked, you should have seen the stock market go down 75%, except then up for inflation and any real growth, right? And so then you ask yourself, well, how much inflation and real growth have we had over those 5 years? And, maybe it's 25% or something like that, 20%. So you say, all right, maybe the stock market you'd think would be half where it was. Well, instead it's up like 40% from where it was. So now, the day that I first saw ChatGPT that Owen was referencing earlier, I texted all my friends and said, hey, do you think the stock market should have just doubled today? Like, this seems like a really big deal. So it feels to me like there are two plausible possibilities. One is the market believes that AI is going to, let's say, 3 or 4x future cash flows of listed companies. And so they're worth 3 or 4 times what they would have been if we had the interest rate change plus the inflation and growth and everything else, but hadn't had the incredible tech breakthroughs we've had. The other possibility is that even though on a day-to-day basis, the market seems obsessed with the tiniest things about interest rates, that somehow on a year-to-year or half-decade basis, the market's like, meh, that's just some crazy, wacky theory that finance professors believe in. Who cares about the real interest rate? So, Meb, I don't know if you have the answer to that. I don't know if you have the answer, Owen, but it feels like those are the two things that could get us to current values. Either it's way too high and the market's making a huge mistake, or it was way too low before and the market was making a huge mistake then, or this technology stuff that's happened in the last few years is not just a modest effect on market valuations, but is really 2 or 3 or 4x what the market ends up being worth.
I would say, Randy, first of all, the Shiller adjusted CAPE yield, excess CAPE yield, it was saying that the market was perfectly normal in 2021, but now the market is overpriced. Not horrendously overpriced, but towards the low rate. So that's like a consistent way of framing that. The other thing I would say is your text to your friends that the market should double, that's crazy. That is a naive statement because just like you said, all companies are going to get this. They're all going to compete away. I believe the term we use is appropriability. Will it be appropriated by consumers or by existing companies? I think when ChatGPT came out, the right response you should have had is GDP will double or something, but not the stock market will double because maybe it'll kill all existing firms. Maybe all existing firms are like Blockbuster and they'll go to zero. So I would have said like maybe a better message would be the stock market should either double or go down 50% tomorrow. And, we don't know which one.
I was being provocative, but I think you're absolutely right. It's really not clear which way this all should play out. So I think you're absolutely right. Yep.
Right. It is a naive myth that everyone thinks the stock market is the economy and whatever's good for the economy is automatically good for the stock market. That's just like way off.
So you're right. So now let me ask you this. We've had since late 22, 3.5 years. Do you have an opinion on whether we should be more bullish, not on AI? I mean, I think what AI has done is equal to or somewhat better than what reasonable people could have expected in late 22. Yeah. So then the question, though, is in terms of the appropriability, I like that word, I'm going to start using it. What do you think? Have we seen news that says, yeah, this will help companies make more money or the other way or too soon to tell? What do you think? I don't have a strong opinion.
I think it's too soon to tell. I will say, and this conversation is really turning into a festival of Robert Shiller's ideas, which is a good thing to have. But
yeah, the man is awesome.
Yeah, but what Shiller would say is like one narrative that is spreading among all normal people is AI is going to take our jobs. And if that narrative becomes the prevailing narrative, that I would think that would make prices go down and that could actually impact people's behavior. So that's the only insightful thing to say. I really don't have good insight into saying, which companies are going to win and which companies are going to lose.
Let me ask you a quick question that's off to the side. Suppose it turns out that AI enables us to produce massively more, right? We have 3 times more stuff, 3 times more electricity and whatever, desalination ability and every good thing. We can build 3 times the housing, all that good stuff. And further, suppose that the political situation in America and globally is such that those fruits are shared. So it's not just like, one person has $2 quadrillion and everybody else is toiling in their underground sugar caves. Will that make people happier, or are you worried philosophically that without meaningful work to do, everyone's going to be miserable?
I have zero worry about that because there is an infinity of wants and people's happiness is determined by whether they feel respected and whether they feel like they're doing meaningful work, which is not the same as producing GDP. So, I think if you had gone back 200 years, you could have said, well, people are not, hoeing the fields anymore and they're not lifting heavy objects. So they're going to feel meaningless. And that's completely wrong. So I think it's completely wrong-headed. That is the last thing in the world we need to fear is abundance and wealth.
So I won't go as far as you. I would say there's some chance it'll be bad and there'll be a spiritual malaise or whatever you want to call it. But I'm on your side of the debate. And one thing that got me thinking about it was I saw a stat, and they do these surveys every few years. They ask college students, how many hours a week do you spend on your schoolwork? And typical is 15 these days. And then I did the math, because I've got kids in college. And so I know they're home 6 months of the year. And I realized, wait a minute, they're working an hour a day. And that includes the class time and the homework time. And they don't have spiritual malaise. They aren't miserable because they aren't working hard enough and aren't being productive enough. So that made me think, that part will probably be okay, although I don't know for sure.
There was a couple random comments. One, as you talk about the disruption, there was a chart we shared on Twitter not too long ago that was saying just what percentage of GDP firewood used to be and that industry surrounding that. And, in the 19th century, it was like a quarter at one point. And so it's probably a good thing we're not all farmers and collecting firewood. But two other comments. One, the biggest challenge I think on the macro side is always thinking that like macro is hard. We did a comment at the end of the year where I said, I like to do these where I said, all right, if we were to go back a year ago and I give you this piece of information, what would you do? Or what do you think the world would have looked like? And I was like, all right, we went back to, a beginning of 25 when I told you gold was going to be up 60% and silver a double. Like, what do you think would be going on in the world? And I think most people would say, oh man, I think inflation ran up, or maybe Bitcoin's at 500,000 or aliens. And what do you think stocks would be doing? People would probably say down 20, down 30. I don't know. And I doubt most people would have said inflation is actually kind of mellow. Stocks are up 17%, on and on, which I think, goes to what we're talking about is a lot of at least in the short term, the macro gets pretty tough.
So first of all, we can't predict what's going to happen. And then when it happens, we don't even understand why it happened. But it's even worse than that. If you had asked me in 1990, is it possible that European nominal interest rates will be very negative for a long time? I would have said, that's insane. That's crazy. That violates every principle of economics. And so it's just like nobody knows anything and we're completely clueless. We need to be humble, I would say.
Going back to kind of thinking about structures and markets and assumptions and just kind of dogma, one of my favorite papers of the past decade probably is this paper that Randy put out. And Owen, you can throw some tomatoes at it and we can debate it. But, it was this concept of best ideas investing. And, I think this was a very popular paper, but also it illustrates a lot of the kind of structural challenges that investors and portfolio managers and institutions face when actually it goes from the theory to implementation. Maybe talk to us about this paper and what was the theory?
What happened was a while back, I was involved in a project that was sort of a fund of funds startup. And so I went around and I talked to probably 100 sort of hedge fund managers, mostly long, short equity hedge fund managers. And usually you'd start the meeting and say, well, tell us about what you're up to. And the manager would talk about an investment in the portfolio. And they would have unbelievable depth of knowledge and conviction and passion about this stock and why it was so great. You'd want to just whip out the smartphone and buy shares right there in the meeting. But after maybe the fourth one, I was like, hey, how many positions are in the portfolio? And the manager's like, 80 long, 40 short, 120 total. And I said, well, you couldn't possibly have that level of passion and conviction and enthusiasm for 120 different names. Your brain would explode from the excitement of it all. And he was like, oh yeah, we have 3 or 4 high conviction bets in the portfolio. And then we kind of round things out with the other 117 names. And I was like, can I just have the good ones? And he's like, no, you may not, and then he went on to explain the economics of the investment management industry and all the reasons why you don't want to run a fund with just a handful of stocks, unless of course you're an activist or in a couple of other very special categories where the market is accepting of this sort of thing. And the shortest version of it is, even if you are a very good performer with 4 or 5 stocks in your portfolio, there will always be a quarter from time to time where you are the worst performer. And everybody on Wall Street has a boss. And what every boss does is they take the list of the performers, they circle the worst one in red and walk up and say, why the hell did you hire this idiot? Get him out of here. And so it's just not great business practice to run those highly concentrated funds. So I could see why it wasn't common, but it seemed plausible when you talk to these folks that they have a few ideas they really believe in and that those might do better. Now, the best way to write this paper would be if you could get every fund manager to tell you every quarter what their best idea was or their best 3 ideas, and then do that for survey for 10 years. You know who's really good at this stuff? Bob Schiller. Bob is a guy who writes these long-term survey papers, and I admire him for it. But, I was here worried about getting tenure. I didn't have 10 years to wait. So instead, we came up with some, we think, reasonably clever methodology. Essentially, we did a Black Litterman who, for people who like this sort of thing, you kind of reverse the portfolio optimization process. If you know the weight, and you can estimate the covariance matrix, you can reverse engineer and say, this must have been the expected return they thought every stock had in order to choose the portfolio they chose. So then we said, and this was for mutual funds, that's the data we had. And we said, hey, now we can identify their favorites, the ones they thought had the highest expected returns. How'd they do? Well, they outperformed other stocks in the same manager's portfolio by about 4% a year. It was very, very impactful. They seemed to know what their best ideas were. And a portfolio of these best ideas seemed to perform really well. And one reason I'm so enthusiastic about this paper is a couple years ago, a group at Barclays decided to test this paper out of sample. So they got a data set that started after we'd put out the original paper, or the first draft, and that used hedge fund data rather than mutual fund data because we hadn't had hedge fund data at that time. And it worked as well or better in the out of sample test. And then you always worry so much when you write these papers that as hard as you try, you can't help but be drawn towards the things that are giving you the better results. And so you're data mining in there when you're trying not to. So it's really great when you have outsiders validate your results.
All right, I'm going to throw some tomatoes now. Okay, so here's my problem with this result, is that people read your paper, Randy, and they're like, oh, okay, the portfolio manager only has the ability, or mostly has the ability, to pick 3 stocks. Therefore, I should hire a portfolio manager that only has 3 stocks. And now I'm not accusing you of anything. I'm just saying
I understand.
Your paper is of a guy who holds 120 positions. The top 3 are the best one. And then they make an unwarranted leap of faith that I should hire a guy who only has 3 because 3 is better than 120. And it's just not true as an empirical matter that the guy who has very few positions outperforms. And it's probably more closely the opposite is true, that the guy who only has 3 positions is just a crazy person. And the reason he is successful is that he is lucky, not because he is good.
I just want to completely agree with you that it is not an implication of our paper that a manager with fewer stocks is going to be a better manager. And that is a great point. And we probably should emphasize that better when we talk about it. I think that's a great point.
And I think getting now to we're kind of going more into the false claims that private equity makes. Well, there's the false claims that concentrated managers say that, like, if you really believe in yourself, you should only have 3 stocks. And anyone who doesn't is a coward and a closet indexer and is trying to steal your money. And that's just nonsense. So I feel like there is this myth that the way to get super wealthy is to only hold a small number of bets. And it's a myth that has unfortunately been perpetuated or spread by Warren Buffett, who spreads many right ideas, but has a few wrong-headed ideas as well. I think that's one of them.
Right. So for starters, even if you could, let's say you could get 100 managers, each of whom pick stocks, and they would tell you their 3 best ideas each. And now you've got a 300 stock portfolio of those 100 times 3 positions. That, I think, would be a really good way to invest. What you definitely wouldn't want to do is pick, a manager and be in their 3 stocks because, obviously you've got volatility, back to our point earlier about the importance of diversification. But you make a great point, which is that there are selection issues in which managers choose to have very low number of stock portfolios. And those could go either way. I don't know of any strong theory that says which kinds of managers. But if empirically it turns out that the people who do choose that approach are less good managers, that's something we have to respect the empirics on. Now, the only thing I know that, sometimes I call attention when people ask about concentrated managers, they say, look, most of the people who are really concentrated out there that I've heard about are activists. Of course, activists are good at getting their names in the press and so forth. So maybe that's why I've heard about them. But it does seem like if you go to a typical institution and you say, I'm a pure stock picker and I'm just going to identify 5 stocks in any given year that I think are the best and bet on those, they're not going to be very enthusiastic about that. Whereas if you say you are an activist, then they're more open to it because they understand how difficult it is to be an activist. And so sometimes I joke that you have to, even if you don't want to do any actual activism, you have to pretend to be an activist if you want to hold that 5 stock portfolio and get people to invest in you. But obviously there are other ways that people justify having those concentrated portfolios. And it may be that the concentrated portfolio sort of draws in charlatans or lower quality people or other things. And that is really interesting if true. Let me highlight one other thing that's a potential source of confusion on this that you and I have talked about, which is separate from concentration, specialization, right? So there is some evidence, and I haven't seen the latest or maybe more recent papers than this, but I know that Lu Zhang, who's a terrific researcher, has done some good papers suggesting that people who specialize, there's a paper on industry specialization that she did with Clement Sialm and others. There's a paper she did with Ashley Sun on specialization in hedge funds. And I find it extremely plausible that managers who specialize would do better than managers who think they know everything about everything. And I think there's at least some empirical support for that. And you'll notice that it's a separate issue from how concentrated one is, specialization. And so, being in, the best ideas thing has benefits. Being specialized, I would argue, has benefits. Being concentrated, I might have thought has benefits, but it may be that the empirics don't go the way one's intuition would. So, these are all things one has to look at separately.
And remind the listeners again, when you pick the best ideas, was that furthest away from benchmark weighting? Was it just the top 10? How'd you guys define?
Yeah, so I want to be very clear on this. What we did was more work and, we think better, right? And that is, so think about portfolio optimization, right? Gene Fama back when I was at Chicago, you say the sky opens and you are given the expected return of every stock and the covariance matrix, the correlations among all stocks and the volatilities of every stock, right? So you're given those pieces of information. Well, then we know how to, you can make a computer do it. You can actually do it by hand with matrix multiplication. We know how to figure out the optimal weights to get the best portfolio from a risk and return perspective out of that information. We're given the expected return, you're given the volatilities and correlations, and you can then say, hey, we should have 2% in this stock and 1.1% in this and 0.03% in this and so forth. Well, so what Fisher Black and Bob Litterman showed is you can reverse the process. So if you tell me what weights you chose to have in your portfolio, here's 1,000 stocks and here are the 1,000 weights that add up to 100%, right? If you show me the weights, and if we can estimate the correlations and as I keep wanting to say correlations and volatilities, the covariance matrix, then we can back out what must the expected returns have been that you thought each stock had that caused you to choose the weights you chose. If it tells you that you thought Apple was going to, beat the market by 1.8%, and your answer is, no, I thought Apple was better than that. Well, then the question is, why didn't you put more into Apple, right? So you back it out. And then we actually did it a couple different ways. One thing you can look at is, what are the highest expected return stocks? Another thing you can look at is, what is the highest expected return divided by volatility stocks? And so we did best ideas, sort of different ways. We rang the changes. When you're writing an academic paper, even though the journals don't want papers to be overly long, they don't want a paper where you say, here's our idea, and here's one table with the results. Bam. You're expected to kind of come up with 10 tables to make it a flushed out academic paper. So then we say, well, hey, some people might say it should be the risk return ratio that really makes a best idea. So let's do that. So it doesn't turn out to necessarily be anything like their biggest holdings or biggest overweights. And let me highlight why. Because let's say that you have a big company that's 3% of the market, right? And you overweight it to 5% of the market. So that's a 2% overweight. That may not be as bold a bet as taking some nano cap company that's 0.1% of the market and buying 0.5% in that one, right? That's probably a much bolder bet. Not necessarily, because it depends on correlations and volatilities and so forth, but logically you might think that that's actually a bolder bet. And what was nice is it's so easy as a researcher, of course, we could say, oh, look, here's what looks like a bold bet to us. But what was nice by applying this Black-Litterman approach is that you have a systematic calculation that you can do to literally say, here's what would have been a bold bet in 1994. So you need that to do proper research.
Are you guys putting this to work? Are you running some tracking portfolios at all?
We are. Right now, it's in managed accounts. I have a friend who started a company, an investment management firm that I'm helping with called Longwall Investment Partners. And he is a brilliant guy, my friend Kerry, and studied as a Rhodes Scholar, lived on Longwall in Oxford. And he's been doing this as a managed account for some of the big clients. And it's been tremendous. It's been several years now. We're really proud of what it's done. And in fact, he sort of stepped it up a notch, which is that he has a long career on Wall Street, and his colleagues do too. And they have built relationships with hundreds of hedge fund managers. And then they go to the few dozen that they think are the very best. And they basically try to get the best ideas from. Some will actually tell them their best ideas. Some of them, they're backing it out from their holdings and stuff. But yeah, so it is something that we're running live.
Randy, aren't you competing with the pod shops? I mean, aren't they kind of doing that same thing internally?
I won't pretend to know exactly what they're doing, but they probably are. And they're probably great at it.
What else is on y'all's brain? Owen, Randy, what's got you confused, excited, worried, thrilled? What are you working on now as we look out to the rest of 26?
I mean, one thing I'm thinking about lately is the world is falling apart, the global economic order, we've got tariffs, we've got all kinds of conflicts between countries. What are the implications for global investors of that? And my thought is that basically from 1970 today, we had globalization and we had all this integration of different countries, Japan's correlation with the US. And if that process goes back into reverse and we go back to the 1970s, the implications are that the benefit of global diversification is going to go up. So, when Japan and the US are 99% correlated, but there's not really that much benefit of being global. But if you go back to the 1970s when they're less correlated, there's great benefits of being global. So my thought is, when the world is falling apart, your portfolio should be putting countries together. You should globalize your portfolio when the world is deglobalizing.
I like that phrase falling apart because obviously usually people mean it to mean things are getting really bad, but you're saying literally separating into fiefdoms or more isolated areas. And that I think is fascinating. Well, along similar related fall apart lines, I've been giving a talk lately when people invite me to give a talk called The 5 Future Fears. And what I argue, it's actually inspired by something Owen wrote a long time ago on another subject. And I think he used the phrase either in the paper or in conversation with me, corporate socialism, and he showed that if some parts of a company were doing very well, if you had an oil company with a chemical division, then oil prices go up, suddenly people in the chemical division make more, their projects get funded and so forth, which doesn't exactly make sense, right? If the chemical stuff's a good deal or if the employees are great employees, pay them more regardless of how the oil division is doing. And so I think that there is a kind of ideas socialism, policy socialism, where if there are 100 important topics in the public sphere, people are smart enough not to give all of them 1% weight. Everybody knows some are more important than others. But I have a feeling that the 80th most important policy issue gets like half the attention that the 10th most important gets when it probably should get like a 50th the attention and so forth. And so the 5 future fears, the idea is, hey, if 10 years from now, the world is way worse. And here, when I say world, let's call it the Western world or the developed world, because I'm not going to pretend that I really know what might be going wrong in whatever Rwanda or what have you. I'm just not close enough to those situations. But if we talk about in America or the developed world, if things are really bad, my guess is it's going to be because of one of 5 factors. And so for all that I would, enjoy a spirited debate with Owen about the minimum wage, and I think it's very much in our nation's interest to get minimum wage policy right, I don't think that minimum wage is going to really be a key determinant of whether America is a great place to live or a cruddy place to live in 10 years. The 5 things I think really matters, I gave them mnemonic names so I could remember alphabetically. A, for authoritarianism. B, for the birth dearth. Some people say fertility crisis. C, for China. Are we at war with China or in a Cold War with China, or are we friends with China? D, for disruptive technologies. So mostly AI there, but also think about incredible things happening in healthcare. And E, for the environment. So think climate change, but I already used C for China. And so then I talk about those 5 things. And because I'm a finance professor, just as Owen was saying, let's think about this from an investor perspective. Obviously, we all need to think of this from a human thriving perspective. But there's a question of, what are the implications of this? So take, for example, the fertility crisis where, the break-even fertility is 2.1 children per woman, give or take, right? So if each woman has 2 children, she'll have 1 girl and effectively replace herself, except you need slightly more than 2 since sadly not everybody makes it to childbearing age. In South Korea, I think the current number is a little below 0.7. So over a lifetime, you would have 2/3 of the population of South Korea disappear. And basically, almost every country in the world is below break even. The United States, I think, is around 1.6. So fairly below, but not hugely below. And of course, because the U.S. is capable of taking a lot of immigrants, U.S. isn't necessarily going to have a plummeting population. But you take a situation where 2/3 of the population is disappearing over time. You say, my gosh, what happens? I said this to my daughter, and she said, well, that's great. There will be affordable housing if you have fewer people. I'm like, yes, honey, what you call affordable housing, people on Wall Street call a real estate crash. So we need to think about the implications if there's less people consuming less stuff. Look, it might be great, right? Owen made the point to me over lunch that we don't know know how these things are going to play out. People used to be worried that we'd have too many people on Earth. Now they're worried we're going to have too few. So I'm not sure how it's going to go. But as people who are caring about financial markets, it's our job to figure out the implications of this stuff.
I'm not sure why the birth dearth belongs under the category of fear as opposed to just change. I mean, as opposed to, authoritarianism, that's definitely a bad thing. The birth dearth, I don't know as much about why it would necessarily be bad or good. But I would think that, just as you mentioned, Randy, Paul Ehrlich died this week, and he was the population boom guy, the guy who was warning that there'd be mass starvation. And didn't happen. So it just kind of goes back to what we were talking about before, is nobody knows anything. Even after it's happened, we don't understand why what happened. So I'm slightly less concerned about the enumerating future fears we don't really know what to do about, as opposed to just dealing with our day-to-day stuff. But I recognize, I totally agree with you, Randy, that we do need to obsess more on the big fears and worry less about the small fears.
And I should highlight, AI is the greatest opportunity humankind has ever faced, but it's legitimate to worry about it and be concerned. If we partner with China, we could do incredible things. If we end up at war is hell. So by no means am I saying for sure that the birth dearth is going to be a disaster, but it's certainly something, we should give thought to and try to figure out. By the way, here's one argument that some smart people have made why it's not going to be an issue. They say, look, overall population growth is small, but there are subgroups that are having lots of children. And what happens is those subgroups will become bigger and bigger parts of the population. And that culture that caused them to have lots of children will tend to be passed down to their grandchildren, great-grandchildren. And so what happens is we might end up with a country that's, the exaggerated version of this is, well, in 100 years, the United States will be 50% Amish because the Amish are having lots of children. And so if nobody else has many kids, we're just going to end up with a whole lot of Amish people. And that's, Amish makes it sound like a joke, but the basic idea of that is not a joke. And so these things are much harder to predict. I mean, look, we know that there are a lot of smart people who've played an important role in the Chinese government over the last 50 years. They made a decision to go with the one-child policy, and now there's a panic there about birth rates and how many people will be around and all. And, people will say, oh, they didn't think about X or Y. Well, maybe they thought about it and thought they were making the right decision anyway, or maybe they really did miss important things. And there's no doubt if you asked me to analyze this, I would miss some really important things. So yeah, there's subtleties here.
Well, if you've read the recent book, I'm gonna forget the author's name, about China. Is it called Breakneck by Dan Wang? Is that the guy's name?
Oh, right. I read about it in Market Revolution. Yeah.
Right. It talks about the guy who made the one policy decision, the one child policy was designed by some guy who was an engineer who had no knowledge of, biology or sexuality or, it was a classic, I'm an engineer, here's a problem, I'm going to apply this wrong thing. So it was a very top-down solution to a bottom-up problem. I would just go back to this AI. I'm not sure AI belongs on your list of fears either, because as Chad Jones of Stanford has argued, yes, it's possible that AI will kill us all, and maybe there's a 1% chance it'll do that, but there's also a 1% chance it'll make us all immortal, or a 2% chance it'll make us all immortal. So the upside is big, the downside is big, but the upside is also big. And going back to the birth dearth, what we talked about, what'll happen if humans don't need to do labor anymore? Well, maybe they'll have more babies if they don't have to, work so many hours. I mean, that's a plausible connection.
If I have to make a stock picking call, I'm going to say bet on health and beauty, right? I do think we are going to have to work a lot less hard, 30 years from now than we work today. And if I'm right about that, if there's abundance, and I think we're heading towards abundance in a stuff sense. And when people have abundance, I feel like, what's the thing they have infinite? You made the point about infinite wants. But if you say there's only so many strawberries I can eat. So no matter how good the strawberry picking robots are, I'm not going to eat more than a pint a week. But there is an infinite demand for health and beauty. And so those seem like good areas to bet on.
You're crazy, Randy, because who knows what beauty, the AI assisted concept of beauty might be totally different. And it's not going to be the same beauty we have now, just like the printing press or whatever changed conception of beauty. The other thing I would say is, what about land, Randy? Because the AI can't make land. So,
My thought there, though, is I feel like, I'll just use desalination as a, kind of metonymy for lots of other technologies. I keep thinking about the fact, Owen, that there is no city or town that I've ever heard of that's on the Pacific coast between San Francisco and Portland. We know people like living on the Pacific Ocean. How can there not be a big city on all that land? And the answer is, well, I don't know. There's no good harbors, and it didn't happen historically, and nobody's doing it now. But I don't know. Once we have the dredging robots powered by solar and wind and everything, can't we like dig out some awesome cities and just? But these are the right questions to ask.
So Randy's buying real estate, and that's his call for this podcast. Pacific Northwest real estate.
Farmland that we can turn into, and there's some people working on this, right? That are trying buying up farmland in inland California and are going to try to build a city there. And there's a lot of people pushing back on it. And honestly, a lot of people pushing back for reasons that I can't see the sense of, but just like there's a part of them that's annoyed by it. So we'll see if they're able to get through. Obviously, doing anything that requires regulatory approval in California, I'm not going to tell you is like an automatic winner, because there's going to be challenges there.
Well, I tell you, the arbitrage that's not too far from where you're talking about, that there's a giant risk premium on this one, but that's the land between probably Ensenada in Baja California all the way down to Cabo San Lucas. No people, absolutely astonishingly gorgeous. I mean, it's basically just California extended all the way down to Cabo. There's nobody there, but of course, you get risk of getting your head chopped off if you're camping and surfing. So that's kind of a trade-off on why it's a distressed asset, perhaps. But same thing, 100 years from now, who knows?
Do you know the story of Beer to Will in Africa? I'm not up to date, but as of a couple years ago when I was reading about this, and I think this is still true, it's like the only land on earth that nobody claims. And the reason is it's something like that there's like one British cartographer drew a straight line across, I believe it's the border between Egypt and Chad, but I might have my countries wrong. And so one drew straight across, and then someone else came along and tracked it along the river. So now you can see there's a triangle on each side, right? And one triangle is sort of the good triangle that both countries want to claim. So each of them, has an opinion which line is the right line based on what gives them the good triangle. But the triangle on the other side of the vertex, that means you have to deny rights to, right? Because you wouldn't want to claim, oh yeah, the line is, the good way for this half and then twists to be the other, that wouldn't be a plausible claim. So the upshot is you have this chunk of land that no country claims to own. And as a result, and then people will do stuff. There was a guy who like flew there and put a flag that he said, now my daughter is the princess of Beer to Will, so you could make his daughter a princess and stuff like that, because nobody claims this land. But of course, there are all kinds of people who are on that land because some people want a lawless area. And so it's not the safest place to visit, much as you're saying with other places.
I want to hear what topics you guys talked about at lunch that were too spicy for the podcast. You guys chopping it up over lunch. What came up that we haven't talked about today? Anything in particular?
Really boring stuff. We talked about Isaac Newton.
Yeah, that's true. But when I trade book recommendations a lot, so that's he.
Yeah. Well, what are you guys reading?
My favorite author is Neil Stephenson, who's, sort of thought of as a science fiction author, although he's a little broader than that, but speculative fiction, I guess, would be fair. And I just think everything he writes is absolutely fantastic. And my favorite of all the stuff he's written is there's sort of a 3-book series, and then there's a 4th book that's connected. And the 3-book series is called The Baroque Cycle. The first book is called Quicksilver, and it's about stuff that happens in the late 1600s and early 1700s, the Baroque period. And kind of the notion behind it, as I see it, is like, if you'd been living through this period, you'd have felt like you were living in a science fiction novel, because Isaac Newton and Leibniz and Robert Boyle and Robert Hooke and Christopher Wren and Spinoza and Van Leeuwenhoek and all these people were just inventing the modern world in an incredible hurry in real time. And at the same time, all this crazy stuff was happening. In 1666, people thought the world would end because of 666. And the world didn't end, but then, or right around then, they had the Black Plague. The city of London burned to the ground. They killed the king, and then the guy who killed the king died. Just one crazy thing after another. And so it's just an amazing time period. And Owen was recommending to me a nonfiction book about Leibniz, that the things he was telling me were very consistent with what happens in the novel. But of course, the novel has made up stuff as well. And so we're interested in the old days as well as the new days.
That's funny. I haven't heard of that series from Stevenson. I read his old book, The Snow Crash.
Well, Snow Crash is insane. And then the book after Snow Crash, The Diamond Age, which won the award for the best science fiction novel, is maybe even better. And I'll just tell you a quick story about it, and then Owen can talk, which is The Diamond Age is a book about a lot of things, but one of them is there's a sort of electronic book that helps raise children. In other words, it's designed to be something that teaches children and that they can, grow up learning from. And I was talking to a guy who was an ed tech expert in Silicon Valley, and he was talking about some ideas he had. And I said, "Oh, have you read The Diamond Age, the book where Neil Stephenson sort of predicts the iPad?" And he said, "Neil Stephenson didn't predict the iPad." And I was like, "What do you mean? That book was out in 1995. The iPad isn't for years later, right?" And he said, "He didn't predict the iPad. He invented the iPad." I'm like, "What do you mean he invented the iPad?" He's like, "You're not the only Neil Stephenson fan, Randy. Jeff Bezos is a Neil Stephenson fan. And unlike you, Jeff Bezos lives in Seattle where Neil Stephenson lives. So he called him and invited him to lunch and said, let's make this thing." And that's where the Kindle came from. And the iPad's just, if Amazonians will forgive me, a better version of the Kindle. But I will tell you, if you read this book, which first of all is just a rollicking adventure of incredible entertainment value, this is The Diamond Age, everything you hear about where education's headed, you will interpret through the lens of what he came up with in this book, because his insights, even though it's now 30 years old, are just so on point with everything people are talking about AI education and how kids are going to learn and how we can make learning better and more efficient. We're still using the learning technique invented by Socrates 2,500 years ago. And that is fairly amazing. So kudos to Socrates for developing something so robust. But I think after 2,500 years of really almost no changes in education, PowerPoint, big whoop, right? I think we're heading to something completely new over the next 30 years. It's going to be amazing. Or horrible, one of the two.
Okay, first of all, Matt, don't listen to Randy, because it is true that Neil Stephenson is a genius, but he is never met a sentence that he didn't like. He is like 8,000% too long.
Yeah.
And
I like long books.
Okay, so it's only a certain kind of person who is able to read anything past Snow Crash. And Snow Crash, by the way, was an amazing book that predicted many events that have happened. And it possibly was too amazing because it somehow got into Mark Zuckerberg's brain that the metaverse was a good idea. And he went off on this whole crazy tangent. And, when we talk about the AI companies that are spending so much on data centers and stuff, like, you should remember this example of Mark Zuckerberg just going insane and renaming his company and doing this whole metaverse thing that was completely, everyone thought was stupid at the time and turned out to be stupid. So the hyperscalers are just fallible people, just like Mark Zuckerberg. And so it's a good question whether what they're doing now, I call it a Zucker blunder. Are they making another Zucker blunder, or is it a good investment in AI and hyperscalers? And, we're not going to know. But I would say that we are absolutely living in a science fictional age. And so it is amazing. And, Elon always talks about Grok and how much of our culture and our Silicon Valley culture is influenced by all these science fictional ideas that are coming true. So I totally agree with that, Randy, that it's like the 1600s or whatever, that we're living in an amazing age.
Gentlemen, this has been a wide-ranging conversation. I had a lot of fun. Thanks so much for joining us today.
Thanks so much, man.
Great to be here.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.